Welcome back to another episode of the Pursuit of Wealth podcast. We got our co-host, Mr. Jace, right here, and we've got another special guest with us. You call him the Team Dave Ramsey. No.
That's true.
But this is my finance bro. This is who I go to for financial advice and help when I am looking at investments or even just getting my personal finances in order. And so I thought it would be a great episode to have him on because we want to talk about, we talked about last episode, getting to a point where you can start investing or putting away 20% of your income. Now, where do you put that income? Where do you put that 20%? Where do you allocate those funds to get the best return? And I think there's, they call it personal finance for a reason. I think it's personal to everybody, but we wanted to go with like a game plan of how somebody could look at structuring that. And Austin's going to be a lot more, probably more conservative than I would be. And so I think it'll be a good kind of yin and yang of like what he would do versus maybe what I would do and maybe even versus what Jace would want to do. But I think we should build it out as like an example. We'll say somebody's making 10 grand a month and they're able to save 20% of that. So $2,000 a month. Where should somebody allocate $2,000 a month? And then I want to build it out and maybe we'll do one for you, Jace. So like, cause you don't have an investment strategy right now, right?
Correct. We're starting from ground zero. So
it'd be fun to we'll use me and Austin's ideas and then you get to decide how you would build this as somebody that's just starting out. So
sounds good.
With that though.
Yeah.
Just as kind of part of the introduction, everybody needs an Austin in their life.
Yeah.
Like even if you're making an obscene amount of money, having someone like Austin in your corner is essential.
Actually,
you guys are giving me too much credit.
It's even more essential the more money that you make, actually.
Yes.
I think when you start making money, you realize that you need an Austin, because things kind of get more chaotic. And to kind of keep your life together, you need somebody that can really dive into the finances. Like I hate tracking money and budgets and all that stuff. Austin nerds out about it. And so you need that personality. I actually think it's on the flip side. I think it's a lot harder for people that aren't making a lot of money to realize that they need an Austin in their life. And I would argue that it's actually probably even more necessary at those lower stages to be able to get to the bigger stages.
I think this is a good way to start the discussion because you guys give me a lot of credit, probably more than I deserve, which is very nice. But I think on the flip side, you need the yin and yang as far as, being conservative, but also being willing to take risks when it comes to actually grow your wealth. And, to give Anthony a little credit, on the flip side, I think he's helped me, make some decisions and take some risks that I probably wouldn't have taken before. And so just to kind of level that playing field out, there's obviously some intimate, involvement between you and I on the things that we do. But at the end of the day, I think there's a lot of ways to approach this.
Yeah.
And maybe not one is the right way. I definitely have the way that I like to go about it. And you probably the way you like to go about it.
Sure.
I think there's wrong ways to go about it.
Yeah.
But maybe multiple right ways to approach this discussion. So
I like it. Yeah. Well, it's kind of let's dive into it. Let's talk about your way first, Austin. Right now, how do you look at when you think about investing or even organizing your portfolio of where you put excess funds? How do you like to look at that? Do you have a certain amount that you like to allocate towards higher risk things, lower risk things? Are you more focused on stocks versus bonds versus real estate? Let's dive into yours first. What do you feel like?
I'll take a step back first because not to take too long of a tangent, we'll take 30 seconds to a minute here. I think even before you look at, investing anything, and you kind of talked about this, I believe last week. I wasn't there for that conversation. And in this scenario you gave us, we have $2,000 whatever allocate. And that's kind of the point of the discussion. But I like to step back and first say living on less than you earn, before you even think about any of this is the most important thing, which your scenario assumes that you have an extra $2,000 a month. So that's fair. But I'd say the first step to building wealth is actually knowing what you spend to making sure that you have that $2,000 a month. And the reason I bring that up first is because I think in all investing and knowing where to put things and how to invest and why to invest is more of a behavior issue than it is, a knowledge issue. Mm-hmm. So getting that foundation in place first and foremost is I think the most critical piece of it. But to answer your question, go ahead.
But on that, like, it is literally impossible to build wealth if you do not have leftover cash to invest.
Exactly. Yeah.
Like, in not even like invest. If you have no cash left over each month, you cannot build wealth. Like, it's mathematically impossible.
Yep.
So
That's exactly it.
And so I think like that is the core to it. It's like, no matter how much money you make, if you don't have money left over each month, you are not going to build wealth.
Well, and to your point, that's probably why, you say the things like it's essential for someone early on to get in touch with an Austin. Because, if we're using our scenario of me, I'm going to play the person that we pick on, right? But let's say the reason I haven't had an Austin in the past is because I'm scared of where I'm at, or I don't want to face that person in the mirror of my finances aren't where they should be. I can talk a big game all day long and say, yeah, I want to invest. I want to do this. I'm going to make more money. But then my lifestyle follows my income as it increases.
Yep.
And I'm in the same boat in 2 years from now. And so getting your finances in order, to your point, Austin, is a critical step one.
Yeah. Yep.
And I think a lot of people, and I appreciate you sharing that and saying that, because I mean, we talked about this morning in our team meeting. Like, it's like 60 to 70% of Americans don't even look, they avoid their own bank accounts because of the stress and anxiety that's going to induce. And they call it like the ostrich effect, where you basically you ignore things that cause stress or anxiety. And the number one thing that causes people stress and anxiety is usually their finances. But unless you know where you're at, you can't ever get to where you want to be.
There's probably a little embarrassment involved in that too. You got some credit card debt or
100%.
You're late on some payments. Your credit score might not be as high as you want it to. Like there's probably a million other things, but you gotta have the humility to start somewhere.
100%.
Or it's never going to change.
You got to be a little bit of vulnerable. Like, you got to be vulnerable. I went to this mastermind a few weekends ago, and it was with some top real estate investors from around the country. And the only way you actually gain benefit from some of those things is being willing to be vulnerable and say, like, here's some of my weak points because like, if I can share my weak points or things that I struggle with, maybe somebody from that group is going to have some input. Like, I was actually struggling with that, a year ago or something. Here's something that I did, and vice versa. I might be able to help them with something that they're struggling with because of my experience. But the only way you get that help is if you're willing to be vulnerable and share that you need it. Mm-hmm. And so I think a lot of us want to have this guard up and act like our world is, like our crap don't stink and everything's perfect over here. It's like, dude, nothing's perfect. My talk about credit score, my freaking credit right now is like shot. And I don't, I like to be, I track that, but like, I pulled another credit card for a company that we started because I want to start earning points on that. And then we just refinanced a house and all this stuff. I get my credit pulled way more than I should because of everything that I have going on. It's not because I miss payments, but like, dude, if you get your credit pulled too much, or my credit limits on some of our business accounts, like we pay them off every month. So we don't ever pay interest on our credit cards. But we max out our limits a lot of the time because we only have a limit of X and our business expenses go up to X. Mm-hmm. And so like, and that's sometimes embarrassing, but it's like, at the end of the day, it's like, who cares?
Right.
Honestly, I don't care. All I care about is for me to be able to get to that next step. I need somebody like Austin that I can share some of this stuff with. And it's somebody that you can trust that, like, at the end of the day, a lot of these guys that do want to help with your finances, they're not going to judge you. Like, he's going to be like, he loves this stuff. And I think for him, I'll let you speak for yourself, but like, I think it helps. It probably brings a little bit of joy when you can help somebody transition their situation.
Yeah. I think what comes to mind first is we're talking about it like we understand it all at this table. I think, the only reason maybe we have the ability to discuss it is because we've been willing to be humble and learn from our mistakes a little bit. Like, one of the biggest common misconceptions I think that people believe is that the more money you have, and the more you grow your wealth, you kind of just get it all figured out. But the reality is as that wealth grows, you have the same problems that someone that has credit card debt or something else has, except you're just dealing with more zeros at the end of it. Yeah. Right. It's the only difference. So it's like, I still have challenges in the businesses that we run together, that I'm running personally, where, I have things I have to be humble about and learn from, and managing my finances and learning how to spend appropriately. Yeah. It's just more intimidating to me because there's a couple more zeros associated than than what I was working with, 5 years ago.
Yeah.
So we're always constantly learning in this, but getting your personal, right, is step one to getting to the point that you can manage those bigger things. So,
yeah, I think there's problems at every stage. And so like I look at some of my really good friends that are really well off. It's like, I talk to them, there's still stuff that they struggle with. Like there's still like some cash flow issues. And it's even though it's like, dude, they have so much cash coming in, but it's like, when they're doing other projects or investing in this, and it's like, that's not as liquid. And now I want to do this. Like we all deal with it. But I think if you have somebody that you can talk to about that stuff it makes life so much more enjoyable. I call them level 5 friendships. It's like, you have your surface level friendships where you hang out with a friend and, the wife and the husband, and it's like, you guys can talk football and little things, things that don't really matter. But there's levels to that. And then you get down to like a level 5 friend, which is like, I try to have as many level 5 friends as I can, is we can put our guard down and actually talk numbers. Talk, dude, like here's my net income this year is struggling. Like my business is struggling. I'm doing this or XYZ, or, we can actually have real conversations. And when you have friends that you don't feel like you have to posture around about like, my revenue is this, but you're always scared to share profitability. It's like, dude, when you can talk to people about actual numbers and share in the journey that you're actually going through, and then share in their journey that they're actually going through, and try to help each other. Like that's what life's about. Like you should be on a hunt. If you don't have anybody that you can talk finances to, like actual finances to, you need to find somebody.
Yeah.
Cause like it's a lonely journey if you're the only one trying to bear all that weight.
Yeah, that's true.
And so I would say, when you can find somebody like that and actually have a true friendship where you can talk numbers and money and income and finances and investing strategy and do stuff together, life gets a lot more enjoyable that way. So there is one thing I want to share too on that point.
It took us on a real tangent here.
Yeah, you
that's
did.
good. That's good.
And this just came to my mind.
Still haven't answered the question.
I was listening to a podcast like about, and they had some financial experts on there that really talked about just saving money and stuff. But the host, who's a really big host, he's like, I actually want to share this with you guys. He's like, I had a buddy that reached out to me and said, he's like, he's kind of in a pickle here. He's got himself into $40,000 in credit card debt. And because of that, he's behind, on his mortgage payment. And his thing was like, I want to reach out to you because you're somebody I trust and you could talk to. I guess they went to high school together. He's like, I really just need to find a way to make some passive income. And I was like, dude, he's like, when you're struggling, when you're $40,000 in credit card debt, the last thing you should be thinking about is passive income. But it's like, it's this trend that everybody just wants, like this magic pill that's going to give them passive income. I want to start an Amazon store that's going to make me 10, 20 grand a month. I want this passive income. Like it doesn't exist. The most passive income is like, yeah, if you invest in like an ETF or get a dividend or that's passive, but you have to have money to do that. Mm-hmm. The only way you're going to get passive income is having money to invest to get that passive income. So like your goal when you're at that stage or you're just starting out is like, you have to go to square one and figure out, how do I get money that I can invest? I need to live below my means. I need to get rid of my credit card debt. You shouldn't be focused on, if you have $40,000 in credit card debt, that is the best investment is to pay that off because that's at 24%. So like you shouldn't be worried about investing or doing anything other than getting rid of that debt.
Correct.
And so I just think that there's this misconception or this twist in this younger generation. I think our generation, even millennials and maybe the generation above us, because I think online, all you see is all these people making passive income, living, abroad or traveling on Instagram. And a lot of that just, it's not reality. Like it could be reality down the road, but like you need a good chunk of change to start investing into things that are going to bring you actual passive income. I look at like even rental properties really aren't that passive.
Far from it.
Yeah, it's like
if someone tells you they have a passive income property, that's the biggest lie.
Yeah, like you can have a really good property manager, but a lot of this stuff, like you're still going to be in some of that.
Right.
And so anyway, let's talk about when you do have the money though.
So you have an Austin in place, I guess.
Yeah.
You've got your finances somewhat in order, hypothetically. You've got about $2,000 a month that you can accumulate and start putting towards investing. Mm-hmm. What do you suggest?
What do you do with that 2,000?
What do you do with it?
Well, going back to, there's not one right answer. I want to reiterate that because I think there's some personal, decisions that play into that, but I'll kind of tell you how I approach it. We were joking earlier that I'm a bit of a Dave Ramsey follower, and I don't follow every single one of his, rules. He'd be pretty disappointed in some of the decisions I make, actually. But I'd say I try to follow, 75, 80% of what he says, because I think there's a lot of truth to it. And a big portion depends on your comfortability with what you're investing in. So, for me, I feel like I understand, mutual funds and basic ETFs relatively well. I don't need a financial advisor to explain to me how they work and what to invest in on that. And I feel like I can invest in those and comfortably receive, a 10 to 12% annual rate of return on that with very minimal work in my, coming from me, I guess, to get that. But it's a Warren Buffett quote where he talks about never, swing, or he uses swing at a ball, like if you're playing baseball, or invest in something that you don't understand. Only take a swing at something when it's in your box and you can swing at it and you're going to hit it. Because you're just going to miss the ball all the time if you're not within your comfort zone of what you're investing in, right? It's something like that. I know I quoted it really terribly, but so for me, it's first and foremost investing some into the stock market, only because I have faith in America over the long term that they're gonna perform and you're gonna get a return out of that. It's a relatively conservative investment strategy, but after I put about let's say 15% of my income, I try to invest a lot more than 15% of my income, but I'll put about 15% of my income in there. That's when I start taking on higher risk activities, personal project, real estate projects. Anthony and I have done a couple things together, and that's where I'd put that money next. And it's something I feel like I understand. I'm surrounded by people that understand it, and my money is relatively secure. Obviously, nothing's risk-free, but surrounding yourself with people that do understand it is just as critical in making some of those decisions. So that's how I approach it. Some people would put less in the stock market, I think, but one of Dave Ramsey's things is he talks about baby step millionaires, if you guys have heard that before. And so my strategy is really, I plan on, having essentially this backup plan that I will be a baby steps millionaire, right? Or multimillionaire is the goal. And then everything on top of that's extra and fun to kind of, grow my wealth in different ways. Mm-hmm. So that way, if my worst case scenario, with very minimal to almost no risk, is that I'm a baby steps millionaire in Dave's plan, essentially is how I approach it. And then everything else is on top of that. But like I said, I try to invest a lot more if I can than 15%. And that's just me. I don't think you have to do more than 15 or 20%. 20% is what we're talking about. But I have the fortunate disposition that my needs are very low to be happy. I'm not a large consumer, so I'm able to invest more than maybe the average person. But I think that's a little bit just my disposition. So
I like that. And I like what you said about investing in things that you understand. I look at like my investment strategy and I look for things that like I might have some competitive advantage about, like with. So like I was actually, when we were thinking that, I'm like, how much of my portfolio is like, or not portfolio, but like net worth is in stocks. And it's only like, I last episode, I'm over here pitching, like you should invest in the S&P 500 and the stock market and stuff. And that's because that is the safest. If you don't want to do work and you don't really feel like you have a competitive advantage in any of the places to invest, it's like, that is probably the best place for you to put it, because you don't have to do any research to invest in the S&P 500. And you just know historically it's returned about 10% a year. So it's like, for sure that's a win. Like just put it there if you don't know where to put it. But it's only about 5% of our net worth that's probably in stocks. Aside from we have some money in like our company brokerage, which I look at as my like safety, my 6 months reserves.
His high risk stocks.
It's actually it's very volatile. But like last meeting that me and Austin were meeting with financially, he's like, I would say like maybe buffer up your reserve accounts. And I'm like, well, this is kind of a reserve account, right? Like it's pretty liquid and like I'm not going to do anything with it. But anyway, like I'm pretty high risk, especially because I'm at a young age and I feel like my income making ability is strong. And so I'm probably way on the other side. And because of that, like even the last 2 years when I would take random, really bad, not gambles, cause I wasn't betting on sports, but like my buddy was doing option trading and I was like, dude, he told me how much money he made in option trading. I was like, dude, I got to do this. Like, and so I literally, I spent like 20 grand and I was like buying options. And at first it was cool. I made like, there's one morning when I was brushing my teeth and it was like about a 3-minute period and I made $1,500 and I was like, this is the coolest thing ever. And then I lost it all. I literally lost like 15 grand trading options because one of my options just didn't pan out how it was supposed to. And then you can easily lose your money. That is the one investment that like, it is high leverage. Like your upside is really big with options, but your downside is like zero. Like it'll just go to zero.
Yeah.
Mm-hmm. And I didn't understand it. Like I didn't really ever understand options and I still don't understand it, but I just saw somebody making money with it. And I'm like, well, I have some money that I'm willing to risk and try this. Yeah. And I think that's after doing that, and then I've played around with crypto. And again, I don't really understand crypto. And there's, I've bought and sold, and I wish I would have kept my crypto that I did have, but, like I just didn't understand it. And so I look at some of the returns that people have made on stuff. Like you look at the guys that did invest in crypto that crushed it. It's like, everybody's like, well, if you would have just invested in Bitcoin, it's like, but I didn't understand it. And I didn't do the research to understand it. And so like now I own a little bit of Bitcoin, but it's like, I understand enough to know that I'm just going to allocate some resources to this because I think if you look at the returns that it's done over the last 10 years, it's like insane. It's like 140% a year. So it's like, well, I'm willing to take a little bit of my portfolio and put it into there just to risk if it does have high returns again. Mm-hmm. But I think like you should only invest in things that you understand and then decide how much risk you're willing to take. And I think that risk needs to be in proportion to your ability to make money. Like if you're at a 9-to-5 job and your income's pretty just like, if we're in our scenario, if you have $2,000 a month, I would not risk that full $2,000 a month. Like I would say you need to allocate it into certain resources. And I'd probably say like at least 50% of that, depending on the age of this person. But let's assume how old are you, Jace?
I'm 30.
30. Let's assume they're 30. I would probably say allocate at least 50% of that to a stable, more safe investment. Doing the S&P 500. I would even also argue maybe just doing like the NASDAQ 100, because I think that return is over the last 10 years has been like 18% annualized. Obviously there's bigger swings than the S&P. Like when the NASDAQ goes down, it goes down pretty heavy. But when it goes up, it goes really up really good. And I think when you're looking at these investments, it's like, understand what the reason I would say that NASDAQ now moving forward is like, it is the top 100 technology companies. And it's like, I only think we're becoming a more technological. There it is. So I
went to Shelley, folks. I went to Shelley.
Technological. I think our society is only getting more involved in tech. And so I think all those tech companies with AI and everything are going to have a pretty good upswing. And so I would say like, even if you don't want to do any work and try to pick the best tech companies, just get the conglomerate of the top 100 and start buying that, or the S&P, get the conglomerate of the top 500 in the stock market and just invest in those. Mm-hmm. And then decide like if there is something that you do want to research. Like I think there's going to be a ton of opportunity within AI, but like only handpick companies if you're willing to spend the time to research and figure out and formulate a plan of why you believe that. Because I think when you start handpicking companies, your risk increases significantly. That's why they look at like, I think even the best hedge fund managers in the world still only average like a 13% return. Warren Buffett being the exception. I think he's averaged more, but a 13% return because they do try to handpick companies, and the ones that win big, but then the losers also lose big. Yeah. So
there's a book called The Intelligent Investor written by Ben Graham. It's one of Warren Buffett's mentors, I guess, at Columbia University when he went to school there. And there's all sorts of research about performance of different groups that are trying to beat the market and get ahead of the curve. And I think, 99% of people that try to beat the market don't do so well, except for the people that are absolute experts. Warren Buffett is the prime example of that, of someone who's done a really good job of that. So I have a funny, just something that's kind of interesting going off of that and like trying to pick stocks and, what do you do here? What do you like? What's the best decision? Like, what's the worst decision? I always love this, but if you guys had to guess, what age do you think Warren Buffett first became a billionaire?
I have no clue.
Billionaire. I would say, I think he's worth like, what is he worth right now? Like 100 billion?
130 or something. I don't know what it is right now.
I don't even know how old he is now. How old is
It's
he?
like
now?
80
something.
So I figured he was really old, but
Yeah.
I'm going to guess mid 50s.
Yeah. 56.
That's
Okay.
good
That's
job.
pretty good.
Let's go.
Yeah.
But the thing that's even more interesting to me is that he made 90% of his wealth after he turned 60.
Wow.
Right?
Yeah.
Which kind of puts into perspective what compounding does.
Yeah.
So I'd say even less important than picking the right thing. But when you put it in, leave it in there.
Yeah.
Stop trying to mess with it a ton. Now if you have extra disposable income and you want to play with options and you have the ability to, that's great.
Yeah.
But if all you have is $2,000 a month and you really need to save for retirement and get there, like you shouldn't be investing in options like you were saying, right?
100%.
Best thing you just put it in something good that's diversified and just leave it there. Don't touch it. Don't pull it out. Leave it there for the long term. And compounding is a wonderful thing, but only if you leave it in there for the entire time it needs to compound, right?
Only if you get that compounding effect.
Right.
And I think this is the part too with people is like, it has to be, you have to have the right mentality when you're going to put the money in, let's say in any investment, but it's specifically like the stock market. I think it's like, if you would have missed the top 10 trading days out of the last 10 years, it's like you would have been negative return.
I don't know if it's negative, but you definitely miss like a massive chunk of the gains that you could have potentially gained. Yeah.
Yeah. And it can be so emotional when you're investing in stocks. It's like you put that, and that's why I say like when you can decide I've got 20% of my income and I'm going to buy it every month regardless, then when you're taking advantage of the downside because you're still buying when it's down, and then it helps offset that loss, and then you're going to get a lot more of that upside when it does recover. And you just got to know like the trajectory of, unless the US absolutely fails, like trajectory is like over time it's going to go up. Now the question is, can you hold over time? And the only reason you wouldn't be holding is if you need to access that money. And I think that's where the benefit of understanding how much I spend each month, and I'm allocating this 20%, and it's going away. Like it's not for me to just grab when I want to go on vacation. It's staying in this for the long haul. That's when you're going to see the biggest benefit. And I think that's when you need to look at a compounding calculator and be like, if I just invested $2,000 a month for the next 20 years, like what would that compound to? I'm sure I can ask ChatGPT, but I'm sure it's in the millions, So anyway, yeah.
And that can be applicable for anything. So like this hypothetical situation is $2,000 a month. If that is $200 a month for you, then sweet. Everybody's got to start at some point somewhere, and it will compound over time. And then that can eventually increase to $1,000 a month, and then $2,000 a month once you've compounded some of it already or increased your income. We kind of talked about it last episode, like go find more ways to make some more money and be able to invest more. Mm-hmm. But yeah, start somewhere. Doesn't have to be $2,000 a month right out of the gate. Obviously, that's just our hypothetical situation.
Yeah.
Let me give you another fun tidbit here, right off what we're talking about. So, $2,000 a month.
Yeah.
In the stock market, I put it at 10%, and anyone that listens to this can be like, well, it's not 10%, it's 7%. And so be like, well, it's 12%.
Yeah.
The reality is the way I look at it is I put 10% in. Let's say there's 3% inflation every year. So what that does is that makes this reflective. If it was a higher percentage, it would be reflective of, if you say 12%, let's say is really what it is in the mutual funds, then 10% is reflective of also including inflation, let's say. So there's some flexibility, it's up or down, whatever you think is fine. But I think 10% is reasonable enough. But 35 years, so Jace, you're 30. Mm-hmm. By the time you're 65, that turns into $7.6 million.
It's average retirement age, 65 from your job.
So 7.6 million. And that would, if you could get a 12%, 13% return, that would be an actual today's money.
Yeah.
Right? Accounting for inflation, which I think is important to do as well.
Yeah.
And it's like that doesn't take that much effort other than behavior, not knowledge, right? We've given everyone the key that listens to this to make $7.6 million.
Yeah.
You don't need any more knowledge than that.
Mm-hmm.
Not some smart thing you got to do that is like, that's all you got to do. And it's done. You know, now in this group, we're ambitious. We want to do more than that. But I just think that's like a baseline behavior that people need to understand that you can do. Anyone can do it.
Yeah.
You know?
And it's like the fun game. Like when you start that, now the game is like, can I get a 15% return somewhere? Can I get a 16% return?
That's where the other 50 comes in.
Yeah,
like
that's
the little more risky type stuff.
That's what I'm like, if you can set aside that, you know, put that 50% into something that's stable, guaranteed, you know, not guaranteed, nothing's guaranteed, but that's more stable, and then use that other percentage, especially at a young age. I think if you're 45 or 50, it's like you have a different strategy. But I think if you're 30, it's like, yeah, go out and see like where could you get a little bit better return on some of this money. For us, it's like, because we have a competitive advantage with real estate, it's like I can usually get a way better return on my money in real estate. And so I look at it and like, man, if I can continue to do some of these deals where we get 16 to 18% on our money, like that compounded over 20 years is awesome.
You want to see that one?
Yeah,
That's
I'd
wild.
love to see it. And so I'm curious to see what this is first.
The pressure's on.
Compounding's crazy.
Oh,
It's
it
about
is.
to get wild. $69.2 million.
It's incredible. And that's just off of the $2,000.
That's $2,000 a month.
Man. Yeah. And I it's crazy because I actually look at, like, I've only been making okay money for like the last few years. And to see where my net worth and stuff has changed over the last 5 years. I mean, zero. Like 5 years ago, it was zero, like maybe negative, you know, just to see where it's at now in a 5-year period and where I could probably take that in another 5-year period. Like, it gets exciting. And then that journey gets fun. And now it's kind of like a game. It's like, you know, where can I put my money that I'm going to get the best return, and how's that going to look? And, you know, if you compound it on a calculator, what does that come out to? Like, but that only ever happens if you start. Like, everybody has to start somewhere. You got to start putting the money away. And I think for us, it's hard because a 10% return year one doesn't feel great on $24,000.
Yeah, you definitely have to have a long-term view on all this for sure.
Have to. And I won't even say like, it doesn't have to be super long. I think if you just give it even 5 years, you're gonna be more excited and impressed. And it's the same thing with stocks. I think it's the same thing with real estate. Sometimes we buy deals, me and Austin own a deal together in downtown Driggs that right now is an okay deal. Like, we're not pumped on it, but I bet in 5 years we'll be pumped on it. We'll be like, dude, this deal's awesome. Cash flow's way better. It's gone up in equity. Like, we're going to feel like we were super smart, but it didn't feel like we were super smart in the moment. It doesn't feel super smart to be putting $2,000 away to get a 10% return. It doesn't feel like that up front. But in the long haul, when you look back, you're going to feel like, dude, I'm so glad I did that. Yeah. It was so worth it.
And I think where people really struggle to maintain that $2,000 a month is when the subtle creep of affluence starts to, you know, come into play. Because as you work your way up the ranks, let's say financially, you'll find yourself surrounded by more and more financially successful people. Mm. And some of them are actually financially successful. Some of them just have a lot of debt.
Yeah.
You know, and sometimes it's hard to tell the difference. Mm-hmm. But as that happens, even if you're not consciously thinking, you know, I'm trying to keep up with the Joneses, we all do it. You know, even as conservative and as low as I think my needs are, I suffer from a subtle creep of affluence as I start buying this and that, and I get used to having this and that. And then money that I could have potentially put to investments, I now spend on consumerist items that maybe don't do me all that much good. You know, you start looking at, wait a second, if $1,000 a month is half of 7.6, so it's $3.75 million in 35 years, you know, am I spending $1,000 a month in a way that it's worth it to me to not have $3.whatever million when I retire? Yeah. You know, and looking at the difference, when I've talked about this multiple times in business and personally, but like the cost of capital is a real thing, and thinking about millions versus a couple extra pieces of clothing from whatever store because you think